Welcome to Chapter 7 of the Wealth Management Essentials course. In this chapter, we will be discussing the personal risk management process. In the chapter, there are 7 different learning objectives that we will cover. We will look at the strategic wealth preservation, the big picture, risk in the context of strategic wealth management, how to measure risk, identifying risk within a client's net worth, the family life cycle, and the personal risk management process. There are 5 major concepts to consider when creating a personal risk management plan. First, how should we think about risk in the context of strategic wealth management? So how do your clients view risk, and how does it differ from your view as a professional? That's something you need to distinguish between yourself and the client, and you need to find a way to explain it to the client using their perspective, but also getting them to understand your perspective. Also, how do you think their views will affect their decision-making process? The next major concept to consider is, how do we measure risk? So you can tailor your plan to the risk management needs of a specific client's situation. What is at risk within the client's net worth? So with this question, you need to think, whose financial well-being is at stake? What are the assets and liabilities on the family balance sheet that need managing and protecting? Next is, how does the family life cycle affect risk management and wealth management? So you need to understand the life stage that your clients are currently in, and how should that affect their decision making in terms of their wealth plan. And finally, what is the process for managing risk and how it is defined? So is there a single framework that can be used for all clients? And what aspect of the client's situation should such a framework address? So these are the 5 major concepts that we will look into throughout the rest of the presentation. So we'll start with risk. So traditionally, risk is thought of as risk that the actual return earned on investment will be lower than expected. So risky assets usually have a more uncertain rate of return. As a wealth advisor, you must help your clients manage their wealth by helping them set clear financial goals. So financial goals must have a set monetary value and a specific time frame. So retirement at age 60 with $50,000 of after-tax income, and then you can project how much money will they need to get them $50,000 after tax throughout the rest of their lifetime, for the next 30 years, for example. And based on the client's situation and goals, you can apply risk management tools to the financial goals and build a comprehensive plan to achieve their goals. Now, how can risk be characterized? So there is pure versus speculative risk. Pure risk is one in which there is a possibility of either loss or no loss, whereas speculative risk has the possibility of either a loss or gain. So an example of this is a premature death and a house fire are both pure risks. You either lose or you don't lose. Your house either burns down or it doesn't. Whereas an equity investment carries speculative risk. You either have the possibility of the investment going up or it goes down in value. You also have objective versus subjective risk. So objective risk is one that most people, especially experts, agree is a risk, whereas subjective risk may be perceived as a risk by one person, especially a non-expert, but not by another. Now we're going to look at how you can measure risk. So there are a lot of different ways to do this. Every risk measure, it does have a fundamental weakness that can't be escaped, but all measures require data, and the only data available is historical data. So ideally, we would be able to predict the future risk, but the best we can do is look at the past record and project it forward. So one of these measures is standard deviation. It's quite often used when looking at an investment. It measures the fluctuation around a central tendency, the mean or the average. The greater the fluctuation, the riskier the asset. And the chance of getting a better result than expected is also considered a risk using a standard deviation. So if you have a fund that goes up, let's say 80% in one year, and then the next year it maybe goes down 10%, that's a huge fluctuation. Yes, it's great that you made a lot of money that one year, but it is considered a risk because the fund is obviously more volatile. Standard deviation is used to create the efficient frontier, which shows all portfolios that provide the higher return for a specified level of risk. And we will touch on this in a later chapter when we look at equity securities. Total risk of the portfolio equals the standard deviation, which also equals the unsystematic risk, which is the non-market risk. In other words, it's the actual risk that a specific stock might have or a specific investment might have, plus the systematic risk, which is the market risk. So generally, the markets go up and down, and there is some risk towards that. If you look at macro environmental factors, those basically affect the entire market, and so that is sort of that systematic risk. You can lower the total risk by diversifying, which is increasing the number of investments, and that does just minimize that systematic risk. You also have shortfall risk. This is the risk of not meeting a specified target or financial goal. So the target could be a rate of return, a lump sum by retirement, or just a periodic monthly payment in retirement. Quite often in retirement plans, you might see a shortfall, which just shows that you don't have enough money to cover your retirement income needs. So that's that shortfall risk. It does incorporate a person's goals, therefore it is much more comprehensive. And with this measure, portfolios with lower expected return and lower variance tend to be the riskier option because it has a lower probability of meeting the desired goal. So if you do measure risk in terms of the shortfall risk, you have a client who is saving for retirement and they have a pretty lofty goal, well, it's actually riskier to invest in lower expected earning products like maybe GICs or money market funds compared to stocks, which have a higher expected rate of return. You can also measure risk in pure risk, as we mentioned, which is the risk of a loss with no upside potential, such as a house fire. Actual measurement is complex, but the usual metric is the probability of losing a dollar amount or a percentage of the value of an asset. Life insurers use mortality tables developed from large samples of death statistics to measure their pure risk. You also have time diversification. So this is a less known risk measurement. It is related to shortfall risk, investments and serially correlated returns. So this measure looks at the client's goals. For example, buying a house in 3 years. In this case, investing in an equity portfolio would be too risky for a short time period. But if the client's goals with the money was to retire in 25 years, then the equity portfolio makes sense. So again, time diversification takes into account the client's goals. So next, we'll look at identifying risks within a client's net worth. So you have the human capital risk. It is the present value of future earnings, net of taxes and other deductions. So a person's ability to earn a future income is exposed to several risks, including unemployment, obsolescence of the job, disability, critical illness, and premature death. So sometimes you might buy disability insurance policies or just life insurance policies to cover some of those risks. Then you have pension plans, so they derive from human capital in the form of deferred wages. Therefore, protecting human capital also protects their pension. There can be some risk with certain pension plans where the employee is given the responsibility of making the investment decision and bear the investment risk. Pension plans, they're also vulnerable to the risk of employer bankruptcy. Next is the family home. So owning a family home and paying off the full mortgage helps reduce costs and can be seen as an inflation hedge. It is also a tax-free investment since no tax is paid on any capital gains from the sale of a principal residence. And finally, we'll look at the family life cycle. So the family life cycle has 8 different stages. Starts with you being younger and single. Second stage is maybe you're a younger couple, but you don't have any children. The third stage is you are a couple and you have dependent children. The fourth stage is single and dependent children. So usually you could be one or the other. You don't have to go through each stage. The fifth stage is an older couple with independent children or nearly independent. The sixth is older and single, and the seventh is couple and retired, and the eighth is single and retired. And so you can see the significance of risks based on these different stages. So for example, budgeting is pretty important within the first 4 stages, but not as important with the last 4 stages. Likewise, looking at estate planning usually becomes a bit more important as you get older. Same with retirement planning, investments, debt management. Usually you have more debt in your early years, less in your later years, so it's more important in those earlier years. So you can sort of think it out in a logical way in terms of the important risks and the stages, but it would be important to remember the stages and the description of each for the exam. That's definitely something that could be on there. And finally, we'll look at the personal risk management process. So the first step is obviously identify the risk. So pretty obvious step. Then you want to evaluate the risk. You want to try and control that risk, so minimize it, and cover and ensure the risk is the fourth step. And then you want to monitor and revise the risk management plan. And so those are all the main concepts in Chapter 7. I hope you all found this review helpful, and I will see you all in Chapter 8.